we have a new generation fund managers with us, very different, style of investments. One is from global markets. One is managing mid and small cap, which is very concentrated in nature. From that to Balaji, who manages the portfolio, which is very diversified, to Sonam, who manages the quant strategy and follows quant as a base for her investments. So this is going to be an interesting panel discussion. So let me just kickstart with the question. And I'll request all the panelists to keep their answers within, 2 to 3 minutes. So we have a lot of ground to cover. So I'll request everyone to be a little more time conscious. So to begin with, if we look at India's growth, GDP growth, and India being very fiscally prudent, do you think that India can get an upgrade for its sovereign rating, and do you think that will really chart the trajectory for Indian markets? So what's your view there? We can start from Arindam.
Sure. That's a great point. I mean, I agree. I mean, the fiscal prudence is kind of not many countries can actually, do what India does, especially in the emerging market side. So yeah, there is a good chance of seeing an upgrade. Now, what it does is it definitely opens up for more fund flows in India, right? So on the debt side, I mean, if you think about the corporate bond market, there's a lot of open space that can be taken. So, as you can see, more fund flows coming to India. On the equity side also, there will be beneficiaries. The market will likely become more broader, right? So if you think about, just 3-4 years back, just, very few handful of companies used to control almost 80% of corporate profits in India. So the opportunities are less. So as long as you're seeing new money coming in any form, debt or equity, that is actually good to broaden the market. So that will give you more and more opportunities to invest. So it's a very positive step, I think, if that happens.
Yeah, just to add what Arindam said, of course, upgrade is long due. What I was saying that from S&P in last 1 decade, they have not upgraded. They have maintained our rating BBB negative to just outlook has been upgraded from negative to stable to positive. So there are definitely upgrade is possible considering one of the large economy and growing fastest space. So and this upgrade will definitely help us to garner more funds. We will get more allocation from the global funds, be it debt, be it equity, and though equity FIIs are consistently selling from last 2 years, we believe that at one point of time it will stop and they will have to come back because except India, they may not be having big opportunities.
So I have a slightly different view here. One thing is upgrade. The other thing is that S&P is not just looking at the central fiscal deficit. It is also looking at what the states are doing. And if you read the election manifesto of the state political parties, it is actually quite scary. The kind of freebies, the kind of schemes that they're announcing, all this is going to weigh on the upgrade. Yes, upgrade can happen, but it's not like the debt to GDP ratio of India is probably around 80%, 83%. It's not like we are the only country which is disciplined. So there are many other emerging markets where the debt to GDP ratio is actually lower than India, and they're probably one notch above us in terms of, as Arpit mentioned, they're probably BBB or something like that. So the state discipline is also very important along with the center for a meaningful upgrade to happen. That's my view.
See, I totally agree with your point that it's not a guarantee that the upgrade will happen. But yeah, I think we are moving in the right direction, right? If you look at the budget that came this time, we all expected the government will spend a lot of money here and there, but they ended up raising taxes and, sort of consolidating fiscally, which, I think pained us as investors, but it actually strengthens the country and makes us a good candidate for, upgrade. I think inflation in India is low. Political stability is there. So I think there are a lot of factors that might play to get us upgrade. And if that happens, I think that would obviously bring in a lot of fund flow and would be quite positive for our economy. So yeah, I think nothing is a guarantee for sure, but we sure hope that all the things that are being done lead to a upgrade, right?
So I can, probably get a gist from this that we might have to wait a little longer and get our, states to do better job to get a upgrade. I think that's what I can sum it up to. So now moving on to the next question. We have seen that in August, broader markets have actually reached a peak. And major money was made in mid and small cap. So do you think that will continue to do so, or do you think that now there's a need to look at large and mid caps, or maybe moving to defensive, or do you think that this rally of mid and small cap will continue? And why specifically I'm saying this is because if we look at last 1 year's number, I think if I'm not wrong, mid cap has given close to 51% return, and small caps have given close to more than 57% return. So do you think that this trend will continue? So we can start from Sonam this time.
Yeah, so I think there's still a lot of potential that is left in small and mid caps, and if the market is positive, right, you see that small and mid caps will end up outperforming. What I would say is maybe not the same small and mid caps which did well in the last year will do better this time. I think sector rotation is going to happen. We are seeing a lot of interesting sectors and tailwinds come up. If you look at, for example, in the chemical segments, agrochemicals, textiles, right? So the same theme as last year might not continue, but new themes will emerge. And I think there's still a lot of potential in small and mid cap. We're still picking stock. We're seeing a lot of things. So I think there is potential, and but yeah, see, if for certain sectors like IT and pharma, where there could be a whole new bull trend that could happen due to the rate cuts, you might see large caps do better. But I still think that in the broader market, there's a lot of potential.
Sheetal, it's almost become a compulsive thing to say that mid and small have performed and therefore should we move to large. Okay, so I'll just take a slightly longer answer for this, right? So if you're an investor who is in Indian markets in the late 90s and early 2000s, okay, so you could have created a significant amount of wealth if you're present in the top 30, 40, 50 names. Your two-wheeler penetration in India was very low. Four-wheeler penetration in India was very low. We were still underbanked as a population. Whereas in the mid caps and the small caps are untouchables largely, because there was lack of corporate governance, unorganized sector was very high, tax compliance was questionable, and so on and so forth. Fast forward to 2024, what has happened in the large cap space? Your two-wheeler penetration has gone through the roof. If you say India 1, India 2, India 3, even India 3 owns a two-wheeler today. In the urban side, India 1 and 2 also own a four-wheeler today. And as a population, after Jan Dhan and everything, everyone has a bank account. So, and the same constituents are there in your large caps today. So, which are the actual large caps in India? The actual large caps in India is Apple, which will complete this year with 70,000 crore turnover. Microsoft will do 30,000 crores. Meta will do 25,000 crores. You have a situation like IBM, Caterpillar. All these companies have doubled their turnover in the last 4 or 5 years. Alphabet and Amazon are also growing very fast. These companies are not listed. So today the large cap growth is happening outside the Nifty. And today the mid and small cap growth is happening in the market because your tax compliance has gotten better, corporate governance has improved, unorganized to organized theme is working. So to say that mid and small has outperformed, yes, I'm not talking the market up. I'm not saying that markets are cheap or anything, but I'm saying that there is still a lot of opportunities in the mid and small space. There are definitely areas where narratives have overtaken numbers, but to just blindly move into large caps, we need to look at how the index is constituted, what are the index stocks that are present, what are their growth prospects before making this move.
Yeah, just to, I agree with Balaji and Sonam that there are a lot of opportunities available in small and mid cap space. Particularly, see, there are two angles to look at it. One is what large cap top 100 companies are providing opportunities. You have around, if we take Nifty 50, only 2 sectors dominate 50% of the market cap, like banking, financial, and IT. So, if you want to say place sector specific rotation, like what trends we are seeing from last 3-4 years, like defense, railways, then mining companies, etc. All the companies were into small cap. So small cap definitely provides very large opportunity. However, at the same time, people who are just buying past winners may not make the money. They will have to, as an individual investor, as a fund manager, we have to be very specific on the stock selection. If you identify good stock selection, then certainly there is ample opportunities.
Yeah, I'd probably echo with what Arpit Balaji said. Thankfully we are in a market which is broad enough, and it is broadening with time. So it always gives you opportunities, but as long as we are prudent with the valuation, we are prudent with the fundamentals, how they're growing, there will be definitely some laggards, the pockets of growth which are not being captured by the market. So there still remains those kind of opportunities, but again, probably the broad-based growth might be under challenge, but the opportunities still exist in different pockets of market.
So I think all of you kind of echoed that, there are pockets where still opportunity is left. So, want to understand that how you will really pick up those stocks, or maybe what you will look at in those stocks, so that you can identify that these are the right, choice for, wealth creation for client. So we can start from probably Arpit and then can move to Balaji.
Yeah, so Care PMS, we call ourselves as a kind of a conservative valuation. We probably would prefer to companies with fairly valued, with good growth aspect. At the same time, there are good, sector rotation. There are visible, visible factors that is happening at the economy. So it will be mix of both bottom up plus top down. At bottom up, preferably, you get industry leader at fairly valued with great cash flow, and you get story for 3-4 years. That is a good option. At top down, at Care PMS level, I can share particularly that we are very post-election, post-budget. What we believe is that, government's focus will be more on the rural side. So rural-related rural economy grows well. So probably agriculture-related sectors, those should do well, and we would prefer to have some allocation on those pockets.
Sheetal, for us, the key element is market share gain. Market share gain is a powerful tool as far as wealth creation is concerned. So market share gain can be within the same companies, same industry, or it can be due to change in the consumer behavior and taste. We were $800 per capita in 2008. We are at $2,500 per capita today. So the taste and the preference of an Indian when they consume products and services, the way they consume the entertainment, the way they eat their food, the way they travel, everything is changing. So I'll just give you a couple of quick examples. Dairy, we are in an audience, we are in Chennai. We all know how we never used to buy store-made curd. The milk was bought from outside and then it was made into curd. The byproducts of milk was always made at home. But today, your value-added dairy is growing greater than nominal GDP. So sectors that are able to grow greater than nominal GDP definitely create wealth. Second, take the case of furniture buying. Who is engaging a carpenter these days to buy a furniture? Everyone goes for factory-made, ready-made furniture. Why? Because there is a young couple, there is paucity of time. There is no time to engage with a carpenter. So you go for factory-made designs, and therefore the raw material used for such furniture is showing a growth which is greater than the GDP growth. So when you focus on such sectors, then wealth creation happens. In automobiles, for example, in 2008, 3 out of 4 cars that was sold in India was a hatchback car. So a professional with 1 or 2 years of experience, the first car he or she buys is a hatchback. Then after the 3rd or the 4th promotion, he or she buys an SUV or a mini SUV. Today, what is happening is 2 out of 3 cars sold in the country is a SUV or a mini SUV. Because income levels have gone up, self-esteem have gone up, second order impact of roads getting better. You want to go on a drive from Bangalore to Goa during the weekend. You don't mind paying for features like ABS and airbags and all these things. Therefore, the SUV and the mini SUV manufacturers are gaining more market share than the hatchback manufacturer. So wherever there is this market share gain, due to company executing better within the same industry, or due to consumer moving on from one product to another, then wealth creation happens.
Yes, so I sort of have a, like I said, quantitative approach to how we detect opportunities. And, the focus shifts with the shifting market. What we've seen in the last year is just following along with the trend has been an amazing strategy, right? Momentum has worked really well. You pick up stocks in differentiated sectors, even PSUs, defense, railways, like we discussed, all of them have done well. But right now, I'm seeing a shift, right? If you look at the last month, you would see that a lot of stocks that had run up quite a lot are not doing that well. But what we are seeing is stocks that are valued relatively well in the same industry. The stocks that have good valuation compared to the peers are getting more attraction. And yeah, if you are doing bottom up stock picking, like Balaji said, finding those industries where the growth is happening, and we are seeing such emerging industries in India, right? From electronic manufacturing to green energy to water, so many emerging trends happening where you will see so many opportunities. So yeah, I think in today's market, you definitely have to look at valuation. You have to find out turnaround plays, stocks that are
Okay.
coming out from the bottom. I think that's the play, right?
I want to specifically ask about US market to you. We have seen that US tech stocks have seen some correction, and specifically Nvidia fall. We saw that it corrected almost by 25%. Do you think that these stocks are in bubble territory, and there's a lot of hype in AI? Or maybe in that segment. Just wanted to get your views there. And how do you see US markets?
Very interesting question. In fact, if I think about what is happening in Indian market versus what is happening in the US market, actually polar opposite. So in India, we are seeing a broad-based rally, right? So you see small cap, mid caps tearing up, and large cap kind of lagging on a relative basis. But if you look at US, the rally has been, kind of within very handful of stocks. In fact, we were looking at some data points. If you just look at the percentage of stocks which have outperformed S&P 500 in last 1 year, that is just 20%. And that kind of breadth, that kind of narrow breadth is very rare. Last we saw that in 1982. Now, there is a reason. All the tech stocks are kind of, bumped up. They're seeing some valuation because in the other part of the economy, people are not finding earnings growth. Wherever you find earnings growth, you find earnings quality, high earnings quality, you kind of flock there. So the key things, I think, but at the same time, you have to remember that the investments that you are going in AI, that has to be monetized at some point of time. So you have this, initial hype cycle, then eventually you understand that, am I monetizing them? Now, to monetize them, you have to make sure that the enterprises are actually spending. It is not because, you and I are paying for some of the Copilot that Microsoft had brought in, right? So the enterprises have to spend. If the enterprises have to spend, then they have to actually show earnings growth. And if they start to show earnings growth, then there is a good chance of rotation. Right? So that part of the market will also show some promises. And that is where, we saw that a glimpse of it probably in August, in July. If you look into it, interestingly, NASDAQ was probably down 7 or 8 points for 15, 20 days in that span. At the same time, small cap or the mid cap index was actually up 4 or 5, right? So it is not that the market was down. It was just that the overweight in the markets that are down. Going forward, I think there will be some kind of convergence. So when you get some idea when the risk will come down, so there is a high probability of happening that. Talking about specifically, certain stocks or AI, again, hard to find momentum.
Okay.
Sonam knows it much better than I do. Momentum, when it works, it keeps on working until it breaks. So we never know. But we are kind of in a situation where I personally think that the market has to broaden up. Otherwise, the growth premium that we are paying for certain stocks, they will also not be able to hold up. right? So there'll be some kind of convergence. As a portfolio manager, we probably recommend looking into the mid caps, etc. more.
So you're saying that, the frenzy will be
At
over probably.
some point of time, yeah, maybe
Okay.
in 1 or 2 quarter, 3 quarter, you don't know when it is,
Okay.
but there has to be a rational clamp down on that frenzy.
So you're saying that, there will be broader market movement rather than,
Yeah,
top few
but the-
stocks which have moved in last 1 year or so.
Yeah, more rotation.
Yeah,
probably.
more rotation.
Yes.
Sounds good. So, Arpit, again, I'm coming back to you. What I understand that you have a style of management that where you actually pick up or maybe create a portfolio which is more concentrated, right? And what usually we have seen, and it is more of mid and small cap, what usually we have seen that when markets fall, mid and small cap fall the most. And investors kind of, try to exit at that point of time. How do you, really protect your investment and convince your investor to stay put at that point of time?
Fortunately, I need not convince my investors because, post all the corrections, the returns that we have generated is self-spoken.
Okay.
So we are into business since 2011 and the returns of 24% CAGR is, I would prefer that discounts all the correction, what we have seen.
Okay.
First, one has to understand why having a higher concentration on the, few stocks. Actually, that is where the expertise comes into play. All the data is available in public domain. So, if you feel that, okay, this is a multi-bagger and I am willing to remain invested into this company for 4 or 5 years and then allocating, say, only 3% of the portfolio, how much alpha it can generate? Even if it is growing 10x, how much alpha it can generate? Negligible. So that is why, at Care PMS, throughout our last 13 years of journey, we have remained highly concentrated on at least top 5, top 6 of our picks. Now coming to the question about, when there is a fall, there is a sharp correction in this category. Earlier, what used to happen that, people, what I believe is, there were two reasons for it. One, the liquidity was not there. Depth in the market was not there. And there was always a, pendulum of feeling between fearful and greediness. So everyone wanted to enter at the peak and, be fearful when the market corrects. Both the things have, now gone, according to me.
Okay.
The mutual fund SIP to small cap, the data that I have was having somewhere around 2019, they were having around 700 crores of monthly SIP into small cap category, which is now almost 5 times to 3,000 crores. So these funds has a mandate to invest into only small cap category. Okay, so liquidity, I think, may more or less are taken care of. They are waiting. If the good companies, are falling, they would prefer to deploy more and more cash. So depth is there. And second thing, about the valuation of the companies. For our set of companies, we are quite comfortable. So I don't think there will be sharp volatility. There is SIPs, like, Anil Rigo also said that SIP is going to remain in the market. So there will be continuous, good liquidity will be available in the market for this category.
So I think what we are saying is that investors are becoming more sensible.
Absolutely.
And
Absolutely.
maybe
When this is like, post-election results, we got maximum calls from the client that, okay, which are the pockets you would be interested to invest. At the same time, during COVID, we messaged to all our existing clients that, okay, this is probably the good time to, invest, and only less than 1% of them actually invested. So reverse psychology is actually reversed.
Okay. So I think, the education which you all guys are doing, giving a lot of understanding to client, that is really helping, I think. Balaji, what I understand that, your strategy is exactly opposite to that. You believe that more is merrier, and, you create a more diversified portfolio than a concentrated. But again, diversification can be done with concentration also. So any specific reason that why you diversify your portfolio versus concentrated diversified portfolio? And do you think that these two different style works in different period, or it can coexist?
Yeah, so I have a friendly disagreement with Arpit on this because, I mean, everyone has their own way of doing it. And so I believe in diversification for the following reasons, right? First of all, I'm managing public money and I'm in public markets. I'm not a private equity investor. I don't have a board seat. I don't know what the management is doing. I'm not privy to the decisions of the management, etc. Secondly, this concentration is a very Western concept which has been juxtaposed into Indian conditions. BSE small cap index. Any guess how many number of constituents the BSE small cap index has? BSE small cap index has 950 constituents. Last 10-year returns of BSE small cap index is 18%. 18% CAGR. Your Nifty 50 is about 12%. So it's not about diversification. It's about which cap curve you are present in, what type. See, on day one, I don't know if the stock is going to be a multi-bagger. If anyone says that I know this stock is going to be a multi-bagger, I'm not too sure about it. So I have to test the waters. I have to see how the ideation is panning out, whether the management is under-committing and over-delivering, or whether the management is over-committing and under-delivering. Accordingly, I have to keep increasing the weight in the portfolio. I can't start with 10% or 6% on day one. So, see, as an active manager, I can commit two types of errors. Error of commission, error of omission. Error of commission is I buy a stock falls 50%. As investors, they can see in the holding statement that I bought a stock, it's down 50%. That's error of commission. Error of omission is I look at a stock, for some reason I don't buy it, and it goes on to become the next Amazon, then it's error of omission, which the investors will never get to know, I will know. So what makes me awake or what keeps me sleepless at night is error of omission, not commission. If you take a 5-year window, whether it's a concentrated portfolio or a diversified portfolio, I will definitely have 2 accidents. I manage those accidents with my position sizing and weights. But if I miss the next big thing, what happens? In QSR, we know that there is pizza and burger. But in India, is there any Mediterranean fast casual option? There's a company called Kava in US, which has a market cap of 1 lakh crores. There's a company called Intuitive Surgical, which is into robotic surgery, which is part of NASDAQ, which has a market cap of $120 billion. How do I know whether these emerging themes will work or won't work on day one? So definitely we have to test the waters. Therefore, I'm very happy holding 40 stocks in my portfolio. Having said that, the top 25 stocks, 3/4 of the client's money, that is 75% of the client money is there in the top 25 stocks. But I love my tail. The tail component of my portfolio plays as much an important role as the head of the portfolio. So I love my diversification as far as mid and small cap is concerned.
Sure. Very divergent view from both of you. But, we respect your style of management. Now, coming to Sonam. Sonam, usually what we have seen is that, human judgment really plays a crucial role in fund management. And, there are events like, COVID or maybe demonetization. These can't be really captured by a AI model. So how do you really, or maybe a quant model, how do you recalibrate your model and how do you really effectively address this issue or anomalies in your model that, something like this if happens, then how do you really have the impact on the portfolio and how you're going to do that in future? I mean, change in your model.
No, I think that's a very interesting question. So see, when we do quant, or when I say that I'm doing data-driven investing, we are trying to look at all sorts of data, right? So we are looking at price data, we are looking at fundamental data, we are also looking at macroeconomic data, we are looking at market breadth. So the market breadth might tell me, okay, it's a volatile market, there is fear in the market, or there is greed in the market. That will give me some idea on my position sizing on how to deploy. But But for example, if you look at 2008, that was fear, but that fear was extended for a while. That is because there was a lot of macroeconomic shift that happened. So like I said, it's a combination of different types of data. Something will tell you, that there is some sort of volatility in the market, and something will tell you that there's actual macroeconomic stress where, you have to take a different position. So we use various tools. For example, like I said, we combine multiple themes or factors, right? So we have diversification across themes, we have diversification across sectors, which reduces my risk anyways. We have something called regime model, which tells me what is the type of regime we are in. If we are in a risky regime, we take lower risk. We go to slightly larger stocks. That reduces our risk. And then, we go do deallocation in our PMS. We actually hedge in high risk scenarios. For example, during election results, we were the only people who were hedged. So we are very happy because we did not see that much crash in our portfolio. So there are various tools that you can actually use as a quant analyst to sort of reduce risk.
So it's more or less a post facto kind of recalibration.
We try to do predictive stuff, but I would not say we are 100% accurate, right? So if you're 60-70% accurate, that's great. But sometimes you have to do post facto also.
Okay, sure. Thanks. So now, Arindam, next question is for you. Now we have seen in the latest budget, there's a lot of change in the taxation. Do you think that will, give more steam to your style of investment, or do you think that there will be more interest in global markets now since the taxation has changed?
Yeah, so great question actually. Yeah, so look, we strongly believe that there is a good case for global diversification. Just from the mathematical perspective, if you run the correlation, etc., you would find that in normal times the correlation is fairly low between India and US. Now, the friction was definitely a little bit higher investing in global equities for resident Indians. So those things are gradually easing. So if you think about the latest changes, I can talk about actually 4 changes that happened recently. Number 1 was definitely the long-term tax, right? So that was brought down to 12.5, which is very much in line with what the domestic equities have, right? That's number 1. Then secondly, if you think about in terms of the ease of opening a bank account in Gift City, right? So previously, if someone suppose invested in global equities, they want to redeem, what they do with that money? Do they want to bring it back to onshore? Now you can actually open bank account in Gift City, which is again a very positive step. Then another thing that came up is around the minimum ticket size. So the minimum ticket size was around $150,000. And if you think about, the limit, that is $250,000. So if you're, investing 150 out of that, it typically, doesn't leave much room. You might need some other expenses. You might have to send money to your kids who is studying abroad, right? Now, with newer regime, we are seeing that the accredited investor actually can invest much lower amount, right? So in that way, we are seeing that, things are getting much more smoothened, which is good. You want a two-way traffic. If you want to really build that a good trading hub, you want outbound as well as inbound. And as much as you can make that frictionless, that better it is. So in that sense, I would say these are good positive steps in terms of global equity investing.
So some attraction towards investing in global markets.
Absolutely. Yeah.
Sure. So now, usually what we have seen that Quant usually have a higher churn ratio. And since the taxation has gone up, the short term and long term both on the equity, do you think that will have some impact on your portfolio? Or do you think that investors have become relatively more smarter, that they don't really worry about the taxation and concentrate more on, performance?
I think that's an excellent question, and we do get a lot of questions about taxation. I think Akshara is also going to write an article, she was telling me. So I think what we see is that, every active manager has a turnover, right? So you would see Anybody who is managing capital actively might end up paying between 30 to 60, 70%
Yeah.
in terms of short-term tax, and which is what a quant strategy would also do. What we have done is we have done an analysis. If you compare, a 5-year performance of, let's say, holding a mutual fund, right, where you are paying only long-term tax versus a strategy where you're paying 70%, let's say, short-term and 30% long-term, what we have to do is only beat that mutual fund by 2 or 3% in the long term, and we have still done better than them in the in post tax. And if you historically go back and look at data for different PMS and AIFs and active managers or quant managers versus a mutual fund, for example, we've completed a year, we've done 78%, and you compare that with a mutual fund which has done much lower, right? So the performance differential that we are able to make, that sort of accounts for whatever tax component could be there, right? So we are not worried. I think many of our investors have understood. They understand the thesis.
Okay, sure. I think all of you guys spoke about, sector rotation, and we have to capture that. So now this question is with regards to factor rotation. So do you see in your models that, from value, are your models moving towards growth or maybe quality, and from momentum it is moving towards low vol or more defensive sort of factors? Do you see that trend in your model?
No, 100%. I have been doing this research very extensively recently, and I see that price momentum, which is just trading price trends, is not doing really well in the past couple of months, right? So that is lagging, but value, even earning quality, right? You talked about volatility, that is doing well. So yeah, there is a factor rotation that is happening after the budget that came, but there are other big events that are going to come. So you never know when the rate cuts will come and what the impact would be. Will they bring back momentum? You never know what's going to happen. But right now, yes, we are seeing that people are getting a little bit biased towards value and quality. Even right now, if you talk to investors, they are looking at undervalued opportunities, something that can turn around instead of chasing the high momentum plays.
Okay, sure. Arindam, now I want to ask you a question that India being, and we kind of all agree, and all the, speakers who spoke earlier said that, this is the decade for India. And, we have entered that zone where, this is a golden decade for India. Do you still see that, investors from India will still go ahead and invest in global markets? And there's still case for, investments in specifically US, Europe, or maybe, some country where the growth is relatively going to be higher from that perspective?
Yeah, no, that's a great question, Shital. You're right. I mean, even I believe that, not only this decade, I mean, probably next 20, 25, 30 years, not many countries would be, actually, I don't think any large economies would grow at the same pace what India is growing, right, or going to grow. Having said that, I mean, just if you just think about few numbers here, we are talking about a $50 trillion economy by 2050, 2055, so 30 years from now, for example. We are now at 3.9 or 4, around that. So we're talking about a 13 times from there. If I look back 30 years, like say 1994, India was a $300 billion economy. Right now we are at 3.9, so 13x. That what has happened in the last 30 years, we expect that to happen, which will probably happen. At the same time, China grew around 20x in GDP. US grew from 7.5 to I think 27 or 28, so 3.5, so 4x. Now, just look at take the largest indexes, the primary indexes of those countries, okay? So in those 30 years, India saw many changes, like low base effect, right? We just came out of the, Narasimha, I mean, all these economic changes that Manmohan Singh ji made. Nifty 50, if I take that, their total return compounding was around 35x, 30 to 35x from 94 to now. S&P did around 50x in INR terms, 50, okay? China did is around 20 to 25x. So that's my point, right? I mean, it is not that, US grew massively faster than India or something like that. The value creation happens in different ways. We don't know. That is the beauty of investing in stock market. The uncertainty part is unknown. What we try to do by diversifying is that just acknowledging the uncertainty, you identify the best markets which can create money. If you go wrong in one place, you probably are right in another place, right? So that's why we want to find uncorrelated assets, less correlated assets, which have compounded beautifully in the history, right? So that is where I think the case for global investing remains intact. That doesn't go away. Now the drivers for India and global are different. When you're talking about India, you're talking about economic growth, etc. When you're talking about investing outside of India, you're talking about productivity, right? The demography is against you. So you are coming up with tools. I mean, everything that you see actually in this room that are helping us to improve our productivity, none of them are actually manufactured or designed in India, unfortunately. So there's a massive value capture that happens in that level. And that is where I think thematically as well as mathematically, if we put that, it totally makes sense.
Yeah, sure. Thanks. So now this question is for all of you. Your thoughts on this new asset class, which will be introduced by SEBI, anytime sooner. So do you think, and this is in between mutual funds and PMS, do you think that this new asset class will provide more options to investors, differentiated ideas, or it will create more confusion, from investors' perspective? And or do you think that it will just coexist like mutual funds, PMS, and AIFs are? So what's your view there? Or it will create a maybe competition for you guys?
Look, I mean, probably very early stages now. We have been still looking at it, but broadly, I mean, I think it is an acknowledgement of the fact that we are maturing as a equity, investment economy, and equity is playing a big role. So when I see that there's a good chance that they'll be opening out long short or inverse ETF, etc. So that is what it is saying, that the regulators are actually taking a prudent view on how to encourage people to build their skill sets for this kind of newer investment opportunity. But again, very early stage in my view to see how it evolves over time.
I also agree to him. Of course, it is too early to say anything, but if the draft regulation, if you go through, it looks like more mainly to regulate category where, they want to have larger exposure to future and options. That is what my understanding is. At the same time, if long only if are permitted, then probably we would also prefer that, we can get the same license, because there is no way why, even a 10 lakh or plus client can, why we cannot handle those clients as well.
Yeah, exactly. I mean, 10 crore client also is investing in mutual fund, and
correct.
maybe.
So I believe it is more to do with future and options, but I still have to, it will be premature to comment on anything on this.
Sheetal, see, when you take, say, the power sector, you have thermal, nuclear, hydro, wind, solar. When you take travel, you have waterways, railways, roadways, flight. So to each their own, everything has its advantages and disadvantages. Financial innovation will keep on happening. I think the regulator felt that between a 5,000 rupee product and a 50 lakh rupee product, there is nothing in between. Therefore, they wanted to bring something in between. Who knows, maybe there will be a new asset class for 2 crore plus or a 5 crore plus investor. That is also possible. So the ultimate destination is the same, but the journey is different for every individuals, and each one will have their own ways and needs and requirements and they will choose that path, basically.
But do you think that it will create a confusion? Because there are so many mutual funds, 500 plus PMS, maybe 200 plus AIFs.
Sheetal, US is a 330 million population. Europe is a 330 million population. US has almost 3,000 managers. 3,000 managers. Long only, long short, hedge fund, this, that, all put together, 3,000 plus managers. Europe has 3,000 plus managers. In India, you have 45 mutual funds. 350 PMS providers, and if you remove all the overlap and all that, net total there'll be around 350 managers, which forget India 2 and India 3. If you say India 1 is 300 million population, which is nothing in the overall. So each one has their own skill sets. Onam has her skill sets. Arpit can create his alpha via, concentration. Maybe I will. Yeah. So, yeah.
So everything will coexist
Maybe
is
if
what
I'm
you are
lucky,
saying.
maybe if I'm lucky, I'll create my alpha diversification. So it will all coexist. That's how I feel.
Yeah.
Yeah, so I totally agree with these guys that, see, first of all, it talks volumes about, the country, how the market is evolving. We need all these new products. See, I started PMS a year ago. Before that, we were doing small cases and all these retail products where you have people who want to invest lower amount of capital. So it speaks volumes of that. I also really want to see the things that they're giving in that asset class, which is future and option. I also really want to do that. So I hope they allow PMS managers to do that as well, right? Not just AMC. So that would be my take.
So yeah, kind of, we are near our timing. So, last rapid fire kind of question. What are the big themes to bet domestically as well as global? What are the themes which will really work out in India? And how do you see, this whole uncertainty in, geopolitics globally? US now kind of clearly saying that they are ready to do rate cut, how that will impact the market. Yeah, maybe, rapid fire sort of answer.
Global themes, globally or in India, I think about three primary things. If I have to bet for next 10 years, one is the deglobalization part of it. You can put it in US putting their own factories in different sectors, or China plus one, which is benefiting India, or India becoming a manufacturing hub. So that play comes there. And with deglobalization, we probably see some kind of inflation coming back or staying there, not going into a deflationary or disinflationary kind of situation. To offset that, there will be, the second theme would be, I think, around productivity.
Okay.
Right? And the third thing will be premiumization. So in my view, we live in a world of abundance. Old economic theories that we read, in our undergrad or graduation days, they are built on scarcity. But right now, the financialization globally is at a level, if you just look at market cap to GDP for any good countries, we are too much financialized. In that case, there is no chance of scarcity. So there's too much of abundance, basically.
Okay.
So it can create more wealthy people. So the premiumization trend should move forward.
And how about global markets?
Kind of same.
Same.
That is where it connects actually.
Okay, liner, please.
Yeah, rapid fire. So I'll just skip. The most important part lately has been the government spending. So government intention, what government is looking for next 5 years, that can be one theme one can play. Apart from the, it was earlier ignored kind of segment. Lately, government is doing all the right things. So where government focus is, like what we believe is the farmers' income will double. That is where their focus would be. Considering the latest results, general elections, where they lost around 30 plus seats from the rural India. So anything related to that can be played well.
So rural economy is what you are saying?
Yes. Rural economy related sectors, like we have agriculture, dairy, those sectors can do well. Ultimately, it will be, of course, bottom up, because you will have to focus on the companies which can encash those kind of theory. On the global, I am actually, in last 13 years, we have seen many things. What is, even Donald Trump, what statements they are doing and everything. Well, I believe if you are long-term investor, say, even if from today you are looking for 3 to 5 years, this can negate all the, fluctuations. There will be knee-jerk, knee-jerk impact of any global event. However, if you are sitting with a good time frame in mind, you will definitely make money.
So themes, very quickly, looking for the next big theme is a bit overrated. I'll tell you why. The lithium ETF is the worst performing ETF in the US. Copper ETF is the worst performing ETF in the US. One of the worst performing ETFs.
Okay.
And plant-based meat was supposed to be a very big thing, but if you look at Beyond Meat's stock price, it will tell you a different story. You go to 2018, look at all the Nifty 50 companies, open their annual report and search for the word blockchain. You will find so many companies writing about blockchain. Go to 2023 annual report and search for blockchain. You will not find a single keyword of blockchain. So one of our best picks last year was a so-called sunset industry, which was lubricants.
Okay.
Gulf oil and Castrol, which has got nothing to do with emerging theme. It's already emerged and arguably a dying theme.
Okay.
But it did well. So it depends on which part of the spectrum these industries are, what kind of cash flows they can throw, and accordingly you have to position. Having said that, one thing, when I made my trip to Japan about 4-5 months back, I realized there is no dustbin in Japan. So the kind of recycling that countries like Japan do, it's very different. So recycling as a theme can be a big thing. We are also looking at themes like travel. I think the current Indian wants to travel a lot. So travel theme can also be a big thing.
So are you picking similar themes in your portfolio?
Yes, we are.
Yeah. And are companies available in India?
Yes.
Yeah.
Yes.
Sure. Sonam.
So in terms of themes in India, I sort of like a few new age manufacturing themes that are emerging, for example, in the data centers, for example, in the green energy segment. And I think that will continue to be there. Electronic manufacturing and especially consumer electronics, that will keep on growing in India. Even if infrastructure spending slows down, consumer will keep on growing. So I think we like those themes, and I think something big that we are waiting for, I think across the world, is the rate cut. I think the next few months are just going to be trying to understand what's going to happen with the rate cuts. I think and obviously it's going to be a positive event for our economy, but granularly, how does it impact different sectors? I think that would be something to understand. So I think that is one thing that I'm really looking forward to.
So rate cut is something you're looking at.
Yeah,
how
I
it will
think,
impact.
I think
but
the
any
next
sectors.
See, if you think about it, banking should do well, IT should do well, and all that. But I think you have to look at granularities of those industries, right? Will the bank be able to lend more, given that the deposit rates are low? So those type of things you will have to sort of study. But I think that is going to cause a fundamental change in our equity market and the global equity market, and we definitely have to sort of start looking at that theme, right?
Yeah, sure. Thank you. So yeah, this kind of ends our panel discussion.